Good morning and welcome to this Wednesday, October 9th edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. All right, well, at this point, you can take a look at the charts from yesterday. We had the Dow Jones Industrial Average down more than 300 points, over 1%. The S&P was down more than 1.5%, down 45 points. The NASDAQ down 1 2/3%, down 132 points, and the Russell 2000 also hit down 1.72%, down more than 25 points. One of the things that I definitely noted is short term. Notice all of the key indices failed at that 20-day moving average. So in the short term, we're definitely in a downtrend, but we've seen this before. We had the downtrend back in August. We came back up above the 20. The 20 went above the 50, and then we went right back down below both, and now both the 20 and the 50 are declining. This is indicative of a going nowhere sideways consolidation type of market. So I would say in the short term, there is no trend. We are really trendless. But still, there are some pockets of strength and weakness, mostly weakness yesterday. There was word from, the upcoming trade negotiations with U.S. and China. A lot of folks thinking maybe it's not going well. I don't know. I try to ignore a lot of the noise. I think that a lot of times it just gets you on the wrong side of the trade. Just when you think things are going down, you jump on the short side, market reverses, starts going back up. We are in a highly volatile market still, with the VIX still remaining up pretty high. We'll take a look at that in a moment. But first, let's go ahead and look at some of the sectors. Same thing, really. Outside of technology, which had crept above its 20-day moving average, you can see that the aggressive areas of the market have stayed below that 20-day moving average and rolled right back over yesterday with more weakness. So again, short term, I think we have some issues. Longer term, I believe we're going to break out to the upside. So it's just a matter of how far we go down. We could go down a couple hundred points on the S&P 500. I don't believe we're going to, but we could. And all it's going to take is a few tweets, maybe something gone bad between the U.S. and China. We've seen this before. I think when it goes down and everybody panics and sells off, the VIX spikes, I think there are buyers that are accumulating shares. But again, that's just my opinion. All right, taking a look at a couple of things that we're going to go over today. I just wanted to point out, actually, my bad. I didn't bring up my screen when I was showing you these charts. So I apologize for that. Let me go back over those very quickly just so you can see what I was looking at here. The major indices, all I was pointing out is the downtrend, the fact that we're below the 20-day. You see this green line right here. We were below, came up, tested it, rolled back over. We did that on all the major indices. The Russell actually never even got up to the 20 and has rolled back over. But the August lows have been holding. So far, that is what I would consider our short-term support. That's what we need to watch. If that breaks, I suspect we're going to get a big spike in the VIX. A lot of folks will be bearish. A lot of selling will kick in. And that's why the trades that we have stops in play, because we're not going to sit there and ride anything to the downside. If the market does break down, we'll get stopped out. We'll wait for a better opportunity to get back in. I think these lows are going to hold. If I had to put a percentage on it, maybe 70-75% chance. I do think we're into the stronger period now. Earnings coming up. I just think that the mindset of the market will switch. You go through August and September, not a whole lot of earnings reports coming out. They tend to be weak months anyway. Lots of headline news, most of which is almost always bad. And so it's hard for the market to kind of get going. But I do think that with some of the economic reports that came out last week and yesterday, I think the Fed's going to cut. I think that there's an argument they should cut 50, but I think they'll cut 25. As I've written about and as I've spoken about, I don't believe this has anything to do, or very little to do, with the economy. Although with the ISM manufacturing data last week, certainly the Fed can point to that as a reason to be a little bit more aggressive. I think this has more to do with the strong dollar, the declining environment for commodities, and the threat of not just disinflation, but potentially deflation. And that is the worst environment for U.S. equities, is deflation. So I think that the Fed is going to hit the accelerator again on a rate cut. I don't know if it'll be 25 or 50 again. I would think it should be 50, but I do expect that they're going to cut again this month. And when you think about it, if the economy does, if we get through this trade deal or get through all the trade negotiations and eventually strike a deal, and have historically low interest rates at the same time as having positive GDP, I think this could be still a nirvana Goldilocks kind of a situation for the U.S. stock market, but we'll see. The other thing I'd mentioned on here before I showed you the charts were the sectors. And again, just pointing out, we got the downtrend here in technology. We really have the downtrend in all of the aggressive groups in the short term. Longer term, they are clearly in uptrends. So let's watch to make sure we hold on to the prior lows. As long as that holds, I think we're fine. And I expect that we will get a pop to the upside as we move throughout the fourth quarter. So what I was going to say, I wanted to go through this market recap with you, talk a little bit very briefly about earnings. There was just one company out. We do have Citigroup reporting on Friday. That's going to kick off earnings season and give us a little bit of look into the banks. Citigroup is not one of the best stocks out there. Let me pull up the chart for you. I think it's just kind of middle of the road in terms of the banking stocks. I think there's some that look a whole lot better than Citigroup. Citigroup has not been able to take out that high from July, as you can see. Neither did the overall banking group. And when you look at a relative chart, got a little bit of higher high and higher low, Citi versus the banks. So I guess that's good. But the last 2 or 3 months, it's been down. I think it was BB&T that I looked at. Pull up this chart to show you this. BBT, see how it breaks out above these prior highs? So on a relative basis, BB&T is one of the leaders. So if the banks break out, I want to be in leaders. BB&T is certainly one of them. I think SunTrust also had broken out. Yeah, you can see SunTrust had broken out, and another one that is breaking to a new relative high. So these are the types of stocks that I would be interested in the group. Looking at JP Morgan, which also will be reporting soon, you can kind of see that same type of breakout there, relative strength in JP Morgan. So those are some of the banks I'd be more interested in than Citigroup, but Citigroup is the one that's going to be visible on Friday, and that's the one that we want to be watching. If that bank comes through, reports some pretty good numbers, I think we'll be in a not so bad space. So anyway, talking about some earnings, I wanted to get into those. We'll get into one other company in just a minute. Going to talk a little bit about scanning, a little bit about momentum sleepers, and then 3 you must see. These are 3 charts that I like to show at the end of the show. Usually candlestick driven or something that just looks interesting, patterns, whatever. Just, I think, charts that you might want to be aware of. Not necessarily trade. Some of them will be a little riskier. You may not be comfortable trading those. That's fine. But patterns. We can still get to the point of recognizing patterns, reversing candles. It doesn't matter how aggressive or unaggressive a stock is. You still have these patterns. And I think it's a good idea to take a look at those and get used to them and spot them when they occur. All right, let's take a look at the 10-year Treasury yield. It is up today slightly. Let me update this, make sure I'm getting the latest. Barely up, 1 basis point, 1.55%. But up is up. Anytime it's going up, that's generally a good thing for the stock market because it does signal money is rotating out of Treasuries. So we want to kind of pay attention to that. Let's see, as far as earnings go, I mentioned, let me go back over to this chart. Let's pull up LEVI. Levi Strauss, they came out with their earnings. They beat on the top line, beat on the bottom line. They reaffirmed their fiscal year 2019 guidance. I looked in the pre-market probably 20 minutes ago, and I saw the stock was down 2.3%. Which would take it down roughly 40 couple cents. That would put it back below the 20-day moving average. So we want to watch that. I'm not a big fan of the company. You can see it's been downtrending here for a little while. If we pull up the relative chart, you can see that this has shown a little bit of relative strength versus clothing and accessories the past month. And the group has done okay for the past month. But overall, we've been in a downtrend, and I'm really worried about the group rolling back over here. So this isn't a stock that I would be interested in, but they did beat top and bottom line. Let's see how the reaction is throughout the day today. All right. I wanted to point out International Paper, IP. This is a company that raised their quarterly dividend this morning. They're now yielding 5.3%. Now, when I look at the chart, there's nothing really I like about the chart. It's been a good performer relative to the group, but the group's been poor. Look at the group relative to the S&P 500. So it's a pretty decent stock relative to its group, but still not performing that well because it's in such a poor group. Did want to mention it, though, because it does yield 5.3% now. A number of you, I think, do like the dividend-paying stocks and more income-oriented, so I did want to point that out. Let's see. Next up, AZO, AutoZone, this morning authorized the repurchase of an additional $1.25 billion of its stock. So we'll see whether or not that helps it break off of this support level. I think this was a stock I showed last week in the daily market report as a stock that was hitting support, maybe just I don't remember which section of the report it was in, might have been in the strong earnings chart list, but here it is at a key support level around 1,050, and it's getting some news this morning, positive news. We'll see whether or not that begins a new uptrend. Upgrades and downgrades, a couple that we would like to see. Chipotle got an upgrade this morning, CMG, the stock currently just above 800. I did not look to see where it was, unfortunately, in pre-market, but CMG did get an upgrade. Another one, and this one was doing well in pre-market, Roku, was up more than $3 last time I checked, 111 and change. Got to watch this 20-day moving average. As you know, or many of you, if your members know, we have Roku out as an active alert. We like it on the long side, but it could come off today. I'm going to be watching this, but this was an area of support. Then, of course, we also had gap support right here. This was from the earnings gap up here, went all the way back down, filled the gap, hit this price support, and it bounced. The reason that I think from a trading perspective we have to be careful is that when a stock is downtrending and it comes up and hits that 20-day moving average, a lot of times it'll fail on the first attempt. So from a trading, short-term trading perspective, taking profits and moving back to the sidelines, not a bad thing. Roku is in one of our portfolios. It will remain in our portfolios. We do not trade those stocks that are in the portfolios. We hold them 90 days, and then once the 90 days is over, we let them go, and we put in another group of 10 stocks in each of the three portfolios. So don't confuse the trading, the active trades, with the portfolios. Two completely different methodologies. Roku, when it was coming down, we just felt like it hit an area where it was going to bounce. That's why it went out as an alert. I don't remember where it was, 100, 101, something like that. But the stock now on this move higher with its upgrade today, it could come off and we may take profits from a short-term trading perspective. Because if it bounces off that 20 and goes back down, we can always get back in from a trading perspective. And if it gets through the 20, that's great. If it can sustain it, hold it, it's possible you might want to even get back in if you're trading it, if it can hold through that 20-day moving average. A lot of times that is a difficult area, though. Sleep Number also came out with, was upgraded this morning. That's SNBR. There's the chart. Had the big gap up with earnings, has pulled back. It's got pretty good support down here on 38.39. With the upgrade, we'll see if we can get back through that 20-day moving average. Downgrades, Domino's Pizza just reported earlier this week. Did gap down with its earnings, came rallying back. Now it's getting downgraded. I just think there's probably a lot of manipulation going on with this stock. I would not be interested. FedEx got downgraded. Big shocker there. Look at the chart, big breakdown. I mentioned when this stock broke down below 150, it was probably going much lower. It continues to go lower. Volume's been weak, and now we're getting a downgrade. Now, if we gap down with the downgrade and print a lot of volume and have a hollow candle, maybe it's an exhaustive gap. Way too early to tell, though. I'd have to watch the action and go from there. All right, scanning. What I wanted to do today is just show you a scan that I use. And if you go to your dashboard on stock charts and come down here to your scans, and by the way, there are, let's see here. wanted to go up here to the gears. There they are, the gears. If you're not familiar with this, you've got a number of different panels that you can set up on your dashboard. And I set them all up. I don't have the commentary set up just yet, but I have the other set up. And if you click these, that's what gives you all of these panels down here. I just want to make sure everyone was aware of how you do that, because I think the dashboard can be a really useful tool. All right, so among the scans that I already have, one of them that I'm going to show you is a 52-week high on the strong earnings chart list. Now, this is a chart list that I use all the time. All of our members, I think, are pretty aware of the strong earnings chart list. I spend a ton of time going through and looking at earnings reports, finding companies that beat top line, beat bottom line, are liquid, and look reasonably good on their charts. And if they meet all that criteria, they will go on our strong earnings chart list. All of our alerts will come from the strong earnings chart list. Every stock on our portfolios comes from our strong earnings chart list. If management can't deliver, then we have no interest in owning the stocks. It's as simple as it gets. I've been around the market for a long time, and when companies have problems meeting estimates, those are the types of companies that tend to warn. In middle of the quarter, we want to try to steer clear of those companies as best as possible. It doesn't mean things can't change during a quarter, because they absolutely can. But I think we get the best chance by sticking with companies that are delivering, where management is executing their business plan. They're being somewhat conservative with Wall Street. I would rather a company under-promise and over-deliver than over-promise and under-deliver. So anyhow, looking at the strong earnings chart list, I have a scan, and I'm going to show you. I'm going to edit the scan just so you can see what's on here. But essentially, here's the favorites list. So it comes in and it looks against this favorites list. The volume, this is the default. The volume is greater than 40,000. That doesn't even matter. I already know every stock in this list is liquid. It wouldn't be in this list if it wasn't liquid. I just didn't take out that because I know they're all going to be over the 40,000. And then today's high, the daily high, is greater than the last 253 days highs. So that's how it's written in code. Anytime you have any kind of code written up there, I always do the check syntax just to make sure everything's good, everything's correct. Now I click Run Scan, and it will bring up anything that's on here. Now, of course, it's nothing on here at this point. So let's go back and look at, see if we can get one that maybe will work a little better for us. Let's look at RSI 40 to 50. Same thing, strong earnings chart list. So I go into Edit Scan, and this is just coming up on a different workbench, but basically the same thing. Now this says all stocks. I want to change that, because if I want to run it against my strong earnings chart list, I have to go in here and select my group. Going down the favorites list, you can see strong earnings. I click it. I will then update criteria, and now you can see that for the last intraday update, it's going to look at my strong earnings chart list and go back and pull those on this list that have an RSI between 40 and 45. Let me make sure yes, 40 and 45. So I'm going to run the scan and see what we come up with. Now, when you look at these, and we got 78 of them, of course, the market had a big down day yesterday, and we've been consolidating for a while. So that threw a lot of stocks down into this group. One thing that you can do, you might look at this and say, well, 78, this is too many. I could go back and say, well, just give me the stocks that have scooter scores above 90 if I wanted. So I could go right back in here. And I could go find the scooters, probably down under one of these. Oh, there's scooters. So I could say, give me all the scooters greater than 90, and I could run another scan. The other thing I can do, though, without doing that, is simply going in here. I've got the results. I can sort by scooter. And so I can see the ones right here that are above 90. So that would just be an extra step. Now, by doing this, I now have some of the best scooter ranked stocks that have RSIs back around 40, 45. This is really important because it's telling me some of the best stocks that have now come down into a range that during uptrends, many times the RSI 40 to 45 area will hold as support. Now, when I look through here, I see a lot of these are software stocks. And software has been beaten up, no doubt about it. Many of the stocks have gotten hit very hard. But when you go through here, you just have to take a look and see if there's any that look appealing to you. First one up here is an internet stock. Now, I can tell you, internets love the month of October. This little snowflake over here is the seasonality tool. I want to see how CDLX, oh, it's only got 2 years. Never mind. That's not going to be able to give us a whole lot of information. But I do want to pull the chart up and just see if it's near a key level. And I think this one actually is. Nice volume trends. It's been selling off. I think you got a nice little down channel, mostly volume trends remaining positive. I'm going to stretch this out a year, update it, and now I'm going to annotate, because what I see here is a nice uptrend, higher highs, higher lows. I see a couple of levels that I really want to pay attention to. Number one, right there, big volume move on a breakout above 30. We got up to 40, and now we're moving back down into the lower 30s. I think as we get closer and closer to 30, that looks pretty good. But the other thing is that recently we've been holding 32. You can look back at late September, also in the middle to late or latter part of August. This 32 level's held. So I could make the argument that we're getting pretty close to an area where might want to start building a position and keeping a fairly tight stop. Maybe you go back to the top of this gap support and say if closed below 29, I get out. 32 to 30 could be accumulation zone. Target would be all the way back up here near 40. That could set up for a nice trade. And all I did was just ran a quick little scan against my strong earnings chart list for stocks that have pulled back. And that's the key here. Here's your RSI. So see how it was overbought? We really don't want to chase these stocks. So when a stock gets overbought, I would tend to wait and see if you can get a little cheaper. Sometimes the 20-day offers up good support. I don't know if there was a negative divergence. Actually, yes, on the final high right here. Higher price, PPO rolls over. A lot of times that'll give you a 50-day test and a center line test, which is exactly what we've gotten here. I think this thing's consolidating and likely, more than likely, going to go higher. So that's just the way I run my scan, make some evaluations, and potentially find trades. Now, CDLX is an aggressive stock. It's only been around a couple years. You can see a lot of times trades less than 500,000 shares. It's not for everybody, but if you're willing to take some additional risk, CDLX looks pretty interesting. All right, momentum sleepers. Going into momentum sleepers, there's a lot of different ways I could do this. One of them would be the scan I just ran. Literally, this is a momentum sleeper. Stock's been rising, and now it's pulling back. Maybe it's off a lot of folks' radar because it hasn't been breaking out. CDLX, I think, would qualify as a momentum sleeper. But what I would do is, another way to do this is to go through the member tools over here, look for scooter reports right here. That is under your summary pages. Scooter reports, you click on it. Now, if you want to look at large cap stocks, maybe you're a little less willing to take on risk. You feel more comfortable with larger stocks. Then it comes up as your default. Now you can switch it to mid cap, small cap, ETFs. You can do whatever you want. But what I would do is maybe look at this and say, well, I know computer hardware is strong. So maybe take a look at computer hardware and some of these stocks that have scooter ranks down around the 60s, 70s, maybe even in the 80s. Apple, I think, looks really good right now. I wouldn't exactly call this momentum sleeper. I think Apple actually just recently broke out to a new all-time high. So I'm okay with Apple. But what about Seagate? Seagate been pulling back. Doesn't look very good, right? Look at these big red candles. Heavier volume. Doesn't look very good. Well, if I pull up a one-year chart, we did have this breakout. I think it's coming back down close to price support. So to me, a stock like Seagate is a potential sleeper. 50-day moving average right here. You got this area of support between about $48.50 and maybe just under $50 from these prior highs. I think this is an a zone where you could see buyers step in and STX could turn back to the upside. So here's a good example, I think, of a stock that is a momentum sleeper. But I could do this for, you know, all of the different industry groups that we've talked about that are strong or strengthening. Let's look at, say, defense stocks. Pull them up. Here's the large cap. It's in scooter order. Raytheon, not as much, but maybe Lockheed Martin's pulled back a little bit. Yeah, right on the 50-day moving average. So here you're in a strong group with defense, but you've got a stock that's pulled back. Still got a scooter score of 93, but we're getting a 50-day test. Not a bad, I mean, when you look back, that's been where this stock has been bought and where it's gone higher. Let's see, another area, I mean, we just talked about internet stocks. I mean, internet stocks have really been not struggling, but maybe lagging a bit, but we know they like October. So, I mean, Twitter right now is one of our alerts. Twitter, I think, has pulled back, right? You see this support from the earnings. There's the bottom. That's gap support down around 38. I think this 38 to 40 area is pretty critical for Twitter. Stock was 46 a little over a month ago. So if you can get it down in a support zone, internet stocks kick in, we could have a really nice push to the upside. Anyway, that's just one way to look for some momentum sleepers. All right, going to go into the final segment, 3 you must see. And these are stocks that I just think are worth monitoring, looking at for one reason or another. First one I'm going to bring up is Keysight Technologies, KEYS. Big down day yesterday. Of course, a lot of these technology stocks got hit yesterday. I think they could be presenting an opportunity. I'm going to pull this up on a relative chart. So you can see, number one, that Keysight has been a pretty strong stock versus its peers and versus the S&P 500. There's your big gap up on earnings. I'm not going to annotate, but if I drew this in, I would draw it to the bottom of gap support, which comes in just below $90. Recent high up around 102. I think as Keysight gets down here, again, I think this is an area around 89. It could go down to 83. I don't think so. I would look for that gap support to hold. Look for a possible reversing candle. A hammer with a tail below that gap support and a close back above, to me, would be an indication that it's ready to reverse, maybe make another run at that 100, 102 area. So that is my first 3 of the 3 you must see. Second one, this is a stock actually that I had written about when I was talking about medical equipment stocks not that long ago. This was in a symmetrical triangle pattern. And a symmetrical triangle is, first of all, you need an uptrend because it's a continuation pattern. So you need something to continue. But there is your lower highs. Here are your higher lows. See how that's squeezing? That's a symmetrical triangle. Look at the breakout. Look at the volume coming in. Now it's gotten up, broke out, and it's pulling back. I think that rising 20-day moving average is going to be very interesting if we get back down there. So that is the area that I would watch, that 20-day moving average. And so keep that one in mind. And then the last one I have, this one's going to be a little bit more aggressive. It's in pharmas. It doesn't trade a lot. But let's take a look at CASI. And the reason I like it, look at the volume all of a sudden picking up on these moves. And look at the light volume as it comes back down. And look at the reversal yesterday as the volume begins to pick back up again. Now, this has not been a leader. It's not been really anything worth considering, but that area of support has been holding for the last several months just below $3. We tested it again and reversed off of it. And like I said, volume started to come back in. This is one maybe to keep in mind. So that is the reason I have it in my 3 you must see for this for today. All right, so that is going to be a wrap for today. I do appreciate you all so much for joining me. Remember to tune in to Trading Places Live from 9 to 9:30 a.m. Eastern, Mondays through Thursdays. Be sure to check out my blog, Trading Places with Tom Bowley, every morning, as I'll provide you a webinar link as to how you can access my shows. Have a great Wednesday, everyone, and happy trading.